Can you spot the difference between a good strategy and a bad strategy? Well, you might want to watch this video because after 8 years of trading myself, after making millions of dollars from the market, and in fact verifying myself by showing a track record of 6 months of trading, showing over a 60% gain live ahead of time, and because I've sat down and had conversations with some of the most experienced, profitable traders in the world, ICT traders, SMC traders, fundamental traders, higher time frame traders, lower time frame traders, I've had the full spectrum. After talking to hundreds of traders, after trading for almost a decade myself and trying out basically every strategy, here is my official tier list to say what is baller, what is profitable, what is trash, and what is almost there. So certain KPIs, key performance indicators, we have to look at is obviously precision and accuracy. These two are different terms. For example, precise means you have a pinpoint entry, but that's not really so important for a lot of traders. Rather, you want to just be in the trade. So precision is important, but it's not the be all and end all. But accuracy, how accurate you are in terms of win rate, well, that is definitely something important. Your risk reward is definitely important. The time it takes to achieve a risk reward, because somebody might get a 1 to 5 in a session, another person might get a 1 to 5 in 3 weeks. So we have to consider that. Certain strategies I think are better for prop firms with the rules of prop firms, because if you're holding a trade over the weekend and for weeks on end, you're going to have heavy swap fees. That's something to consider. Also, the consideration is the learning curve. For example, certain strategies you can get a grasp of within just a month because they're very simplistic and basic. Whereas other strategies, it might take you years to truly master. So there's so many moving parts when we judge a strategy, but a lot of newbie traders, they just go with this strategy works because I tried it out for a week. Or this strategy works because my mentor has 1 million followers and therefore he must be correct. We have to be a lot more calculated when we decide what is an effective strategy. And we don't look at it one-dimensionally. We look at it holistically and we judge it on multiple parameters that are logical and optimized for overall profitability to give it a full encompassing score. And that's what I'm going to be doing. So first up, we have Elliot's wave theory. Now, Elliot wave theory is something that is like the nerd of the industry. You know, that guy in class that was really textbook, studies everything, and the guy who can have an answer for everything, but he's not really profitable. And you know what it is? I tried it out. I actually did Elliot wave theory myself for a year and I got a lot of knowledge into it. And what I realized is you can always do a recount. And when you have so many options and ways to count the waves, the impulses and retracements, and because there's always a way to do it, and there's always another way to do it, and there's always another style you can change it to if one thing's changed, or if something goes wrong, you can just do a recount and readjust. All of these things basically gave me the idea of there's an answer for everything, but there's no real plan. And it's very good at telling you what happened because you can just count the waves, but it's not that good at forecasting what will happen next. It's just a good way of doing market structure and directional bias, let's say, but it's no good at risk reward. It's no good at win rates. It's no good at precision. It doesn't really give you a significant edge. It just tells you what happened previously and you give these waves names, and then you can say basically based on that you should have an impulse or a retracement. Not really that useful because then there's so many more things to pick. When is it going to retrace? When is it going to impulse? How far is it going to impulse? How do we exactly see the momentum changing and shifting? When is that higher hike? There's so many things to consider that I think Elliot wave theory is overhyped. People that do it sound smarter than they are, and I would put this in the almost category. But if you focus on other things that I'm going to tell you in this video, and then you have Elliot wave theory as one of your bases, I can definitely see that working. Next is the weird and wonderful word of Ichimoku Cloud. Now, Ichimoku Cloud is something I also did for like 6 months, and it was like I knew about indicators and I knew about EMAs and moving averages and different cocktails of RSIs and MACDs and all of these indicators. Now, in my opinion on indicators, which you should hold the same view, they are lagging, and therefore they are very good at telling you what price has done. But what price is going to do, well, that's another thing. And the reality is your indicator might tell you this is bullish now, and then as price starts to go bearish, the indicator moves because the indicator is just lagging and mirroring price. And it's very good at helping you read price action when you don't have a clue what you're doing because you don't know how to read price action. So you just see it in a condensed and refined EMA. But the moment you learn how to read price action, then you don't need any indicator because the indicator is simply going to tell you what price is telling you anyway. So you'd rather focus on price, which is real time, than a visual representation of price that's lagging and not really accurate and not really good at forecasting at all. So Ichimoku Cloud was a nice cocktail of a few indicators combined together, but the reality is it's trash. You should have clean, hygienic charts that are clutter free and you're only focusing on raw price action, no matter how cool it looks on your charts. And you know when you see those proper traders that you see in the movies and they have like 5 screens and they have colorful lines everywhere, that looks like Ichimoku Cloud, which is why it looks so baller, but it doesn't work. So I'd skip that altogether and put it in the trash category. Next, we have those traders that are stuck in 2018. You know, those traders that haven't changed one bit. They're still making the same posts. They're still flexing the same things and they're still talking about the same things in their videos. That typical online guru that's been around for a few years that is so stuck up on trend lines and Fibonacci. Oh, I mean, that was the way to trade. That was the holy grail like 5 years ago. So many people have moved on from it. That's a huge sign that it doesn't work. And again, I know the big boys, the big institutions, they use trend lines, and the big institutions and the people that are pulling billions of dollars into the market are using Fibonacci and trend lines and maybe even moving averages. But look, you are a retail trader. You are different to a hedge fund that has compliance, regulations, billions of dollars, real liquidity, real executions. They have to have compliance to send an email. So you think their way of trading and our way of trading, we can compare? I don't think there's any comparison. Second of all, they're doing a whole diversification of a portfolio where they're going to be doing AIs, bots, they're going to be running on fundamentals, they're going to be running on price action, they're going to be doing so many things. And of course, they're going to use these higher time frame ones, but they're going to supplement it heavily with fundamentals. They're going to supplement it heavily with other information to strengthen a bias. And then the trend line might be an execution because they're not trying to get a sniper entry or a small stop loss. They're buying a currency and they're looking to hold it for weeks or months on end. And therefore, you can use a support level, you can use a trend line, you can use a Fibonacci level. Price does not reverse because of a Fibonacci level. A Fibonacci level is just a statistical edge. It's a zone of higher probability where retracements are more likely to occur based on historical data. So I can get why it works, but it's not truly driving price. So this is going to be a controversial opinion, but I'm going to put this into the trash category. I would say it's almost, but it's not almost because you have so many other things that you need to work on to make this approach work. And I'd say don't waste your time. In fact, do the opposites, because a lot of dumb money, a lot of retail traders, a lot of people that are just gambling are utilizing these approaches. So why would we want to side with them when there's definitely better ways to look at the market? Next, we have price action traders. Now, there's going to be certain segments within price action trading that are going to be kind of useless. Let's say if you're just focusing on support and resistance, trend lines, Fibonacci, and those like key levels, you know, those round numbers, 1.125, you know, those key levels. That is a very minimalistic and also probably non-profitable approach, but you can take price action really far. For example, you can even use candlestick patterns. For example, dojis, morning star, and these reversal patterns. These are useful. I think there's definitely better ways, but this is a good start because you could have, using price action, you could have a supply zone, and then you jump from a 4-hour supply zone down to an M15, and you look for a candlestick pattern or a rejection, and then you put a stop loss based on that candlestick pattern and you follow the trend. That's pretty good, actually. That can be enough to be profitable. Now, will it be the most precise? Probably not. Will it give you the best win rate? Probably not. Will it give you the best risk to reward? Probably not. Will it give you a very good trade frequency? It can do. It can give you a very respectable trade frequency, especially if you're trading multiple currency pairs. So there's merit to it. I just think it's a good approach. It's a solid approach. It's definitely somewhere you should focus your first year in trading, mastering price action. You don't need anything else. Price action, technical analysis, understanding the temperament, the nature, and the language of price, and building market experience and market IQ and refining off that basis. It's wonderful. It's a wonderful place to begin. So that's why I'm putting it in the profitable category, but I'm not really a huge advocate of it because I think there's so much more to achieve that would probably come under price action, but it's not the typical price action you hear people talk about. Next, let's talk about ICT. You know, the big boy one, the one that has 1 million followers on YouTube, the one that has literally millions of traders following. But where are all my profitable traders? Where are all these ballers that trade ICT that think they're the best because they have the best win rates and the best entries and the best risk reward and the best? ICT has become the holy grail. ICT has become the buzzword. ICT has become the trading gold standard. All these ICT traders that you see on Twitter, online, they're all trading prop firms. Where are they on the leaderboards? I know a lot of prop firm founders and I can tell you they don't say ICT is superior. They in fact say ICT traders are the ones that are blowing accounts the fastest. They are the ones that are gambling the most. They're the ones that are taking too many entries. Those are the ones that are just messing it up. So my opinion is ICT is good. ICT is enough to make you profitable, and I'm actually going to put it in the level above. I'm going to put it in the solid category, but I'm going to say be very careful. ICT is not a strategy. It's a concept, it's a school of thought, and it's an approach to the market. And when you see a strategy where somebody might be buying Euro USD and another person selling Euro USD on the same pair at the same time, that should ring an alarm bell and say, there's not really a strategy. It's just people figuring things out. And when you have a school of thought that is so broad, when you have so many setup types and so many confluences and so many ways to justify price, well, of course, at any moment in time, you can justify what price did based on 100 categories. You just pick 3 of them and say, oh yeah, price did this because of these 3 things. And the next day price did that because of these other 2 things. But that's not a strategy. That's just a justification model. That's just a way to explain price action through a very broad concept approach. But what it truly takes between the 99% of ICT traders that are blowing accounts on prop firms versus the few that I've met that have made over $1 million on prop firms and so forth, the profitable ones, there is a difference between them. And the difference is what you make of the strategy, how you piece it together, the refinements and the psychology and the approaches that you build within ICT is what's going to make and break a trader. So the school of thought alone, is not enough, but it's a solid foundation if you focus on the right things. So I'd say take ICT, take the concepts, and then look for the best 10% of it and focus on that and build very restricted strategies that are based on causation, primary drivers, liquidity, and time, and focus on your ICT concepts with that lens. And I think it'll be a very solid approach because you will have a better win rate, better risk reward, good trade frequency, and all the other metrics that I like, the KPIs, are going to be solid with ICT, but with a huge disclaimer that there's a lot of work to do beyond just ICT. Now, next brings me on to SMC. Now, SMC, which is kind of like a bridge between ICT and SMC, they almost go hand in hand, but I think SMC is a little bit more watered down, a little bit more generic, and a little bit more amateur, and it has a lot more BS in it because they kind of mix things. I feel like SMC traders are taking the watered down ICT, they're eradicating the important things, and they're just fixating on higher time frame structure. They're fixated on the basic order blocks and the basic fair value gaps and all of these large daily fair value gaps, and you do a fib level and an optimal trade entry, and you're just mixing things that you've heard because you don't want to watch the full 1 year mentorship. You just focus on the key points, and they mix it up all wrong. And these are the guys that are blowing prop firm accounts. These are the guys that are most vocal on Twitter, but they're failing accounts. And therefore I'd say SMC is not profitable. In my opinion, SMC is not even a good guide. It's going to be in the trash category because if you focus on SMC alone, you're going to be misguided heavily, and you're going to have such an ego about yourself because you think it's superior, but it's not. And I can tell you with confidence because if you watch my videos where I literally deconstruct and expose SMC and show you example after example where I take trades based on smart money traps, based on these zones where I know the rookie SMC trader is getting in, and I use that as a liquidity pool. I use that as an entry model. They are getting manipulated like crazy. 7 years ago, those things weren't happening. The market has adapted and adjusted to these people. So I'm going to put it in the trash category, and I'd say avoid it like the plague also. But you want to transition away from it towards, let's say, ICT or price action. These things are better, and you can take some of the knowledge and take it with you to that direction, but don't get stuck in the SMC world. Next, we have pattern traders. Now, these pattern traders, they blow my mind. It's trash. It's trash. It's trash. It's trash. The market is not reversing because of a head and shoulder pattern. It's not reversing because of a wedge. It's not reversing because, and even funds are not looking at this. Even the big players are not looking at it like this. So don't be fooled into thinking that Japanese candlestick pattern plus the wedge pattern and plus all of these things you see on Google and baby pips, it doesn't work. Trust me, it doesn't work. And anybody who's been trading for more than a month also knows it doesn't work. It doesn't take a genius. It's where we all begin. It's what we all learn. And it's a very nice introduction into the space. It's a very good way to learn price action, the basics, before you actually look how to trade profitably. I'm putting it in the trash category, but I think it's useful for your first 2 weeks in trading just to get a basis and a feel for things. But don't build it as a strategy. If you're still in 2024 with all the good information out there, with all the profitable traders out there that are giving their strategies, that are teaching you what they do, and you're still stuck on the head and shoulder pattern, and you're still stuck on this like teacup patterns, I don't even know what's going on. Skip it. Avoid it. Focus on good things. Focus on primary drivers. Focus on price action. Focus on raw price action and intention and liquidity. These things are going to make you profitable, not a damn teacup pattern. Now, before I get into the last one, which I saved to the last, is the baller category. I want to hear more strategies that you're doing, and I'll rank them all. I've just done some of the big generic ones that we all know about, and I've ranked them, but I want to do a part 2 where we go into more strategies and the more details of them, and maybe we can do a full category on the styles of ICT and the styles of different strategies, and we do a tier list for that. But the big boy one, the one that I think is the most important, the baller category, the one that's really going to make you profitable, that is optimized for all the KPIs I said, for all of the metrics of judging a system, from psychology to performance to win rate to risk reward to the trade frequency, everything. Deeply understanding the 1 minute time frame to understand the cause and effect. If you see prices approaching a supply zone, how can you see if it's going to respect or fail? How can you see when there's a manipulation happening versus a break of structure? You need to be able to master the 1 minute time frame to understand the session tendencies, the minor inducements versus medium inducements. All of these things are the keys to price. Believe me, I've tried everything, and I wish I could just open your eyes to prove it to you right away. But look, the evidence is there. I've traded every style. I've only found massive profitability with the way I trade now. The reason I can put my neck on the line and publicly give my signals for 6 months, which no one is doing, no ICT trader, no SMC trader, no other trader is calling the market live the way I can, with the burdens of psychology that come with the comment section, and I'm still doing it. And the way I can pull out 60% profit, verify it, prove it, give a track record, document it alive ahead of time, is because it's the best way. It's truly the best way. And if you can master the 1 minute time frame and master liquidity and master these things, the laws of cause and effect and primary drivers and causation of the market, the true reason price moves, you will be able to build any style of strategy, whether you want to be a swing trader, fundamental trader, scalper, intra-session trader, intraday, whatever approach you want. You can build systems and build models that are going to be higher time frame aligned prime setups, or counter trend intra-session impulse trades. You can build different systems. That's up to you on how you combine it. But focusing on these things is the best way. And I put my name, my reputation, and my own life savings on it because that's how I trade. That's how I've been doing it. And I don't have a job. I'm a dentist that left dentistry, left a high-paying career to focus on this, and I didn't do it for nothing. Believe me when I say this is the best approach. And if I had to do it all again, or if I have to get advice to my younger self, I would say focus on price action, focus on SMC and ICT to get a good base. That's your first 3 months in trading. And then spend the next 5 years on market experience, market IQ, and M1 mastery, daily cycle mastery, liquidity mastery. These things are going to really help you elevate to be a true profitable trader. And if you want to be a millionaire, you want to make a lot of money in trading with prop firms or without, you have to focus on these ones. And therefore, this is the only strategy I'm going to put in the baller category. And remember, the key to any strategy, the key to any approach to the market is always going to be the same. A restricted trader is a profitable trader.